Stop watching the price of Bitcoin. I know that sounds strange coming from me, but if you've been watching Bitcoin like it's the next gold rush, waiting for it to hit some magic price, you're watching the wrong thing. Here's what almost nobody on YouTube is telling you. Bitcoin isn't the new gold. It's not even trying to be. The biggest institutional money on Wall Street has quietly figured out something the financial media is completely ignoring, and it has nothing to do with gold. It has everything to do with what's sitting in your retirement account right now. If you've ever felt like Wall Street tells you one story in public while doing something completely different behind the scenes, stay with me. Because what I found in the last 2 weeks is going to confirm everything you've been suspecting. A few months ago, I told you something almost nobody was saying. I said stock markets don't crash first, bond markets do. That video aged well. And what I'm about to show you is the next chapter in the same story. Same playbook, different victim. By the end of this video, you'll understand why the entire Bitcoin is digital gold narrative has been a misdirection from day one. What's actually being targeted is a $28 trillion yield market that almost every retiree in this country has money in. And I'll show you the three specific signals I'm watching before this rotation hits bond, ETFs, and retirement accounts. Let me break it down. Here's the setup. For a decade, every analyst, every CNBC segment, every YouTube finance channel has compared Bitcoin to one thing: gold. Digital gold. Gold 2.0. You already know the pitch. Fixed supply, mined asset, hard money, same as gold. But here's the problem with that comparison. Gold doesn't pay you anything. No yield, no coupon, no cash flow. Gold is a store of value. That's it. Treasuries are the opposite. They pay yield. They generate income. They're the foundation of every pension fund, every 60/40 portfolio, every retirement income stream in this country. Now here's the part most people get wrong. The problem isn't that every treasury has a negative real yield today. It doesn't. The 10-year TIPS real yield is sitting around 2% right now. The problem is that the real purchasing power protection investors thought they were buying has become unstable. Inflation volatility, duration risk, and a tidal wave of new treasury supply are all hitting at the same time. And institutional money is starting to hunt for an alternative source of yield. Here's the question Wall Street doesn't want you asking out loud. If Bitcoin is really just digital gold, why is the smart money packaging Bitcoin into yield products? Why is the entire institutional conversation suddenly about Bitcoin-backed credit and Bitcoin-backed dividends? Because Bitcoin itself isn't a treasury. But Bitcoin-backed credit products are now competing for the same yield-seeking dollars that used to default into treasuries, money market funds, preferreds, and credit funds. That's the rotation nobody's talking about. Now here's the part most people get wrong. The problem isn't that every treasury has a negative real yield today. It doesn't. The 10-year TIPS real yield is sitting around 2% right now. The problem is that the real purchasing power protection investors thought they were buying has become unstable. Inflation volatility, duration risk, and a tidal wave of new treasury supply are all hitting at the same time. And institutional money is starting to hunt for an alternative source of yield. Here's the question Wall Street doesn't want you asking out loud. If Bitcoin is really just digital gold, why is the smart money packaging Bitcoin into yield products? Why is the entire institutional conversation suddenly about Bitcoin-backed credit and Bitcoin-backed dividends? Because Bitcoin itself isn't a treasury. But Bitcoin-backed credit products are now competing for the same yield-seeking dollars that used to default into treasuries, money market funds, preferreds, and credit funds. That's the rotation nobody's talking about. Let me show you exactly what I'm talking about. In one of Saylor's recent 2026 digital credit presentations, he said something the mainstream media completely glossed over. He didn't compare Bitcoin to gold, not once. He framed Strategy's Bitcoin-backed preferred stock products, Strike, Stride, Strife, and STRC, which is a perpetual preferred currently paying a variable dividend around 11.5% annualized, against four very specific things: money market funds, private credit, junk bonds, and the Sharpe ratio of Treasuries. Read that list again. Notice what's not on it. Gold isn't on that list because Saylor isn't engineering a gold competitor. He's engineering a yield competitor. These preferreds are bond-like. They pay regular yields. They're also equity-like. They sit below creditors in the capital stack. They're not treasuries, but they're aimed at the same yield-seeking dollars that currently default into your money market account, your bond ETF, and your fixed income IRA allocation. And he's not alone. Look at the data. MicroStrategy started this trend years ago. But in the last 18 months, the corporate Bitcoin treasury count has exploded. There are now over 100 publicly traded companies holding Bitcoin as a primary treasury reserve asset. Not as a speculation, not as a side bet, as a balance sheet asset replacing what used to be cash, T-bills, and short duration bonds. Now scale that up. Sovereign wealth funds are quietly allocating. State pension funds are running the models. BlackRock, Van Eck, 21 shares. Every major asset manager now has Bitcoin yield products in their pipeline. This isn't a gold rotation. This is a yield asset rotation. And it's happening in slow motion right in front of us. Here's the mechanism, simple as I can make it. The world is sitting on a $28 trillion mountain of US Treasury debt. That number keeps growing. The supply keeps growing. The yields can't always keep up with what every yield-seeking dollar in the system is hunting for. And the buyers, foreign central banks, pension funds, retail investors like you, they're starting to look elsewhere. Where do you go when the world's safest yield asset is losing its grip on real purchasing power year after year? You go to whatever can offer comparable yield with less duration risk and less inflation risk. And right now, that's increasingly Bitcoin-backed credit products. That's the rotation. It's not coming. It's already pulling marginal yield-seeking capital. And the only reason most of the financial press isn't covering it is because their entire viewer base has been conditioned for 10 years to think of Bitcoin as digital gold, not as a competitor for the yield-seeking dollars that anchor the bond market. If this is clicking for you, drop a comment and tell me. How much of your portfolio is in long-duration treasuries or aggregate bond funds right now? I'm genuinely curious where you all sit on this. And if you know somebody holding a 60/40 portfolio who has no idea this rotation is even happening, send them this video. That's how a channel like this grows. All right, back to it. So if Bitcoin-backed yield products really are competing for the same dollars that used to flow into treasuries, what does that actually mean for you? Let's talk about the 60/40 portfolio. For 40 years, the standard retirement advice has been the same: 60% stocks, 40% bonds. The bonds were the safety net, the income stream, the thing that was supposed to protect you when the stock side got volatile. That portfolio has been broken for years. The 40% bond allocation has been bleeding real purchasing power since 2021. And if institutional money is now rotating out of those same treasuries into Bitcoin yield products, you are left holding the bag. Here's what that looks like in practice. Long duration treasuries, your 10-year, your 20-year, your 30-year bonds, those are the most exposed. They got crushed when rates spiked. They've barely recovered. And now their biggest institutional buyers are looking at 11.5% Bitcoin-backed preferred yields and quietly asking themselves why they're parked in 4% treasuries with shaky real return after inflation. The math doesn't work anymore, and the smart money knows it. The treasury market isn't going to vanish overnight. The US government will keep issuing debt, forever probably. But the marginal buyer is shifting. And when the marginal buyer shifts away from your bonds underperform. That's how this works. That's literally how every asset rotation in financial history has played out. This is the exact same playbook from the bond market's crash first video I did. The bond market is the canary in the coal mine. And right now, the canary is twitching. If your retirement plan depends on Treasury yield to fund your fixed income, you need to know that this institutional rotation is real, it's documented, and it's accelerating. This is the part Wall Street is hoping you don't connect. Because if regular investors figure out what the institutions already figured out, that the bond side of the 60/40 is losing its marginal buyer to a new generation of yield products, the panic rotation gets a lot uglier, a lot faster. So, what do you watch for? And what do you actually do with this? First, watch the corporate treasury announcements. Every time another publicly traded company adds Bitcoin to its treasury reserves, that's another buyer leaving the treasury market and entering the Bitcoin market. Track that count month over month. It's accelerating, and the rate of acceleration is what matters. Second, watch the Bitcoin backed yield products themselves. STRC paying around 11.5% variable. Whatever new product strategy or BlackRock or Van Eck launches next. These are the direct yield competitors to treasuries and money markets. If institutional appetite for these products keeps growing, that's your rotation signal in real time. Third, and this is the one I'm watching most closely, keep an eye on long duration treasury auctions, the 20-year and the 30-year. If those auctions start failing or start requiring meaningfully higher yields to attract buyers, that's the canary screaming at you that institutional money is voting with its feet. Now, what do you actually do? I'm not going to give you financial advice. That's not what this channel is. But I will tell you what I'm doing personally. I'm taking a hard, honest look at any long duration treasury exposure in my portfolio. Not panic selling, just understanding the risk that comes with holding a paper asset that's losing real value to inflation and losing its marginal institutional buyer at the same time. Those two forces compound on each other. I'm also keeping a small, position-sized allocation to Bitcoin itself. Because if this rotation is real, and the evidence says it is, Bitcoin is on the receiving end of trillions of dollars in flows over the next decade. That's not a meme trade. That's basic math on the rotation. Here's the bottom line. The Bitcoin is digital gold story was always a misdirection. It made Bitcoin sound speculative and fringe. It kept regular investors out of the move, while institutions quietly built positions. And it framed the wrong comparison from day one. Bitcoin isn't competing with gold. It never was. Bitcoin-backed yield products are competing with the boring, productive, yield-bearing assets that anchor every retirement portfolio in this country. They're competing with your bonds. They're competing with your treasuries. They're competing with the part of your retirement portfolio that was supposed to be boring, safe, and predictable. And the rotation is already underway. If you want the deeper data on this institutional Bitcoin rotation, the full corporate treasury list, the breakdown of BTC yield products, and which treasury auctions are already showing weakness, I'll put a link in the description below. Next week, I'm digging into what happens to bond ETFs specifically during a rotation like this. If you're holding TLT, BND, or any aggregate bond fund, there's something you need to know about how those funds rebalance when institutional money walks away. That video is going to surprise you. Subscribe so you don't miss it. I'll see you in the next one.